For more on what this means for investors, I want to bring in Tom Lee. He's the chief U.S. equity strategist at JPMorgan. Tom, by the way, recently raised his 2011 year-end estimate, the target for the S&P to 1475. John and Dom are joining us as well. Now, you were just telling me you got a call last night about this, right?
Yeah, that's right.
And went straight to work on this.
That's right. That's right. You know, I mean, first of all, we turn on the news. We were waiting to hear from the president. And then we were just trying to figure out, okay, well, is this good or bad for markets? And, at the end of the day, I think this is going to be a lot more than a one-day reaction. I think whatever happens today is basically noise. The reason I think it's positive is, one, people have been avoiding stocks, so they think they've been risky. Part of it's global security. I think this is going to basically really boost inflows into stocks. The second is people have been buying commodities because of what they call fat tails. The idea of, I want some terrorism insurance. Well, we're going to spend less time on tails and think more about relative value. Stocks are super cheap. And the third is consumer confidence is terrible. I know it's jobs. I know it's oil. I know it's housing. But the fact is we just scored a major victory. We caught the biggest enemy of the United States government.
Public enemy number one.
Number one, exactly.
But Tom, would that make someone wake up this morning and say, I want to own stocks? I mean, that seems to be the takeaway from what you're saying.
Well, I think you don't think, okay, well, I want to own stocks, but now all of a sudden you think accumulation of reasons, record corporate profitability, highest equity risk premia in 40 years, housing we think is going to turn, and all of a sudden we're going to think, hey, wait, the U.S. government just scored a major victory. You know what? I've been thinking things are terrible, but you know what? I feel pretty good about being an American citizen. I think that's going to boost equities.
Well, speaking just not of the short term here, but longer term, making a lot of calls this morning to a lot of strategists, analysts out there. Yeah. There was a common theme developing about the longer term implications of this whole thing, guys. And what they're saying is, what does winning actually look like in the Middle East? Is this considered a winning kind of score here? People would say yes. Number two, longer term, though, guys, if you look at what happens, what does this mean about possible military action or withdrawals accelerated out of the Middle East? Because we actually crunched the numbers, guys. The Defense Department has asked for $107 billion for the budget next year just for the Afghan war, and that counts to about $300 million per day. So is the fiscal situation rectified there?
I want to pick up on that because I haven't heard anybody this morning tell me that the war in the Middle East is going to retreat at all, and I haven't heard anybody say that this really damages Al-Qaeda in the sense that they've already got these networks all over the world, and so there is still all that risk.
Sure. Well, there's a couple things I just point out. One, every communication I had this morning is, you're crazy. This is not a big deal. I'm fading this rally, meaning I don't think it's true. Most movements die with the death of their leader. Because, you have to remember, this is a recruitment business, right? And they have a lot of churn. A lot of people drop out. So if you're not able to recruit through a charismatic leader, I think the movement burns itself out.
So a cult of personality, so to speak.
Correct. So I think this is going to diminish the capabilities of Al-Qaeda. Remember, it's really just a handful of individuals that have been directing sort of global networks. Well, if you've now diminished their capabilities, how do you communicate with global networks?
But Tom, you're saying most people reacted to your comments today skeptically.
In fact, I had one guy say it was comical. The second said I should retract the note. The third said, I don't know what I'm talking about. It really happens at pivot points.
And these are people from outside or within your firm?
These are institutional investors. And you know what? It's been a very tough market. Remember, people have been kind of bearish on this. They've been wanting to sell every rally here, and it's been hard to embrace this as a secular bull market.
How will you know, Tom, if what you're saying is coming true? Are you looking at volume levels then in the next few days or in the next few weeks, or what are you looking for?
Sure. There's a couple of easy benchmarks. Year-to-date U.S. equity inflows have been $30 billion. It's half of what it's normally in a bull market, so we should see equity inflows double. So we should be looking at a $7 billion pace. The second is we should see relative performance of stocks versus what we call tail assets. So in other words, if stocks begin to outperform gold, stocks versus oil, we know investors are starting to believe this.
What about treasuries, though? Does it bother you right now that we saw 3.77% as a 10-year yield, and all of a sudden, just a few weeks later, like if X number of months later, it's down to almost 3.25%? Again, people buying treasuries again.
Well, it just shows you the treasury market's a lot more than just about QE, because I think everyone was thinking treasuries would back up because of QE, but you know what? Maybe it's a lot of it's discounted. So it's really hard to tell what the 10-year is telling us. I would just tell you, I'm worried if 10 years at 4.5, 5.0, it really destroys the case for stocks.
It hasn't gotten there because there's so much buying interest.
Tom, I mentioned at the top of the show, oil is down today, but it's been down more significantly at other points during the last month. A lot of people would say oil's got to come down a lot for people to feel better about the stock market. What do you say to that?
We've had to adapt our view to that. At the start of the year, we thought $120 oil, huge problem for stocks. $120 oil is about a 14% gasoline burden for households right now. It's where it was in 05, 06. You need to be at sort of the 150 oil to get to where we were in 08. Part of it is incomes are higher, and part of it's people use less gas.
This is also, certainly a boost in Washington, right? And a boost for the White House administration.
Sure.
Does that in some way have any type of positive effect on the markets that now you've got a president that's on stronger footing, at least for now?
Yeah. Well, just imagine, I think if I was to sort of say what's the outcome, one of them is we feel like we have an effective leader. We've got a government that now is large, resourceful and powerful. We can deal with our problems, and we've got other problems to deal with. We've got budgets, we've got unemployment. I think we're going to feel more confident they can achieve these things. If they can catch Osama Bin Laden, they can catch, they can fix these other issues. The negative spin, which I'm hearing from clients, is well, this might help Democrats in 2012. I don't think it's a universal negative if the incumbent's reelected. So I think in some ways...
You don't think it's a negative for the markets?
It's not universally negative. That's right.
Okay. What makes you say that?
Well, I think if we are talking about an economy expanding at 5% next year...
well, who's we, though? You might be talking about
That's
it.
right.
Others might not.
Okay, so if that's a situation next year and equity markets are doing well, generating tons of capital gains for the government, we could be feeling better about progress on the budgets. And we might feel good that maybe it's going to be sort of a Republican Congress, but an incumbent Democrat. I don't think it's a universal negative, that 2012 re-election.
And Michael, we've got Tom Lee with us, who has basically told us that he's gotten a lot of flack this morning for his report, which he basically declared that the war on terror is over and that investors, should get into the markets, right?
Yeah.
I mean, to sum it up. Michael, what do you think?
Well, I'm just looking at a couple of technical scenarios. I mean, before this news came out, we were looking on Friday at the 1361 level. It was pretty critical in the S&P. And you know what? This morning we gapped above it. We're trading above it. And I wouldn't be surprised if that starts adding as support. In the meantime, crude oil takes a brief dive below 111, and then we're right back above it. You know what? Those are two areas that I'm watching to see if we can breach either above or below, but I'm not surprised. You know what? Euphoria in the markets psychologically sometimes is short-lived. It's these fundamentally technical levels that we also look at to see if they're going to actually hold in. And right now, crude for me at 111 is a big one. We got to get below that.
Michael, how are most of your clients positioned? Part of the reason why Tom is bullish is he thinks there are a lot of bears out there, even though the stock market has been climbing. Are a lot of people that you trade with very bearish on the markets right now and looking for that opportunity to sell?
Well, you know what? A very good example of this is the chatter that was coming into last week about potentially a bubble in silver. And then you saw, because of margin requirements, but you saw an adverse reaction to the downside and how silver traded. If you look at the same chart in gold, we're not seeing that movement. And I think that's kind of the mindset right now is there are beliefs right now that the S&P could fall apart. And at the same time, some of the speculation in metals, in particular, because of volatility, you might see some of these bearish trades. I think what's going to happen is the S&P is going to start nestling in at these levels, and then you're going to see somewhat of a sell-off, but I don't think it's going to be abrupt.
You don't think it's going to be abrupt, Tom?
I think it's going to be very, very rare if we have a 10% correction this year in stocks. Out of 14 bull markets, only one had 2 double-digit corrections in the same bull market. So I think it's rare.
And I know that you raised your forecast. Why did you exactly raise your forecast?
We didn't really want to raise it last week when markets are making new highs, but we were taking a hard look at Q1. We saw that top lines come in at about $108 billion above consensus. It's a huge top-line beat. It's a base effect. It pushed up our 2012 earnings estimate from 102 to 105. And you know what? If we have the same multiple, we had to raise our target to 1475.
What do you make, Tom? I know we're just in the first few minutes of this trade, but what do you make so far that the rally is really not a huge outpouring of buying going on?
That's exactly what we expect. We think a lot of people are going to try to fade this, right, sell into it, and they're not thinking about the long-term effects. I think the long-term effects here is, equity risk premium is high. This is a huge argument for it to come down. People have been buying insurance against terrorism by buying commodities, and they're not thinking about relative value stocks. Well, now I think it's going to push people back into looking at equities on a relative value basis. And then I think confidence picks up. I think we're going to start to see consumer confidence get out of these recession readings that we've had for the last 2 years.
Right. It almost clears things up for you, is what you're saying, right?
That's right.
It kind of removes one piece of uncertainty.
Correct.
Okay. Dom, I know you're looking at some of the movers going on right now. Just give us a rundown of what's moving the most.
Well, you heard Shannon Pettybeast talking about this big deal in biopharma right now. Remember, Cephalon was the target of a hostile bid from Canada's Valiant Pharmaceutical. Well, that's being trumped now. The big generic drug giant Teva gonna buy out Cephalon here for about $7 billion. So that's a big deal there. Turning now towards the entertainment or broadcast arena, check out shares of TiVo, check out shares of EchoStar, check out shares of Dish Network. All of them on the move today. Dish Network and EchoStar have agreed to settle a lawsuit by TiVo. They're going to pay them around $500 million, $300 million up front. So you can see shares of TiVo and Dish Network on the move there. Also, Betty, we're keeping an eye on the downside here. Whole Foods Markets getting a downgrade to hold from buy over at Jefferies. That's one of the biggest losers in the S&P 500 today. So, Betty, lots of stocks on the move here, despite what's happening in kind of a fizzling, so to speak, rally in the first hour here.
Dom, thank you. Just hang on, but we want to continue with Tom here. We forgot to talk about deal news.
Yes.
And, every Monday we've had more and more deals come out. That's giving a bid to the market.
I think it tells you a lot about CEO confidence, right? Businesses are putting their balance sheet on the line, doing huge deals. It tells us that they feel pretty good about the economy and visibility.
And hiring.
And potentially hiring. I think S&P companies have been pretty good about hiring. I think it's sort of the middle-sized and small business that have been having a tougher time getting credit and therefore hiring.
Are you surprised by the type of deals we've had so far, or what sectors we've had them in?
It's not entirely surprising. I mean, we're seeing deals for businesses that want to gain market share or see opportunities. I think what it really feels like is, the mindset 2 years ago was boards were going under the desk, building moats around their businesses. Now they're really focused on market share. It's the kind of expansionary behavior that you really see in bull markets.
Right. It's been sort of the market where we've seen oft repeated, the big get bigger.
Yeah, that's right.
Is part of the reason why you've raised your forecast on the S&P as well, is that companies are spending again, right? And you're seeing that in the earnings reports.
That's right. I think one of the messages we've had for the last 2 years is stock markets are corporate profits, not GDP. Q1's an example. Q1 top line accelerated year over year, yet GDP was 1.8%. What matters more to stocks? It's really the top line growth. I think the Friday payrolls number, though, could be affected by some of the auto shutdowns. So I think our firm is looking for a below consensus print.
People are asking, when do companies start spending these profits on people? When do they really start to add? Because they've got this extra money.
Yeah, I think staffing levels at large companies is actually pretty full. I mean, I'd say that, it's the service sector as pricing power improves, they'll do some hiring. But on the margin, the big hiring really needs to come from small, medium business. Housing, by the way, is one of the hugest employers. If we can get housing starts up, every 250,000 incremental starts is 1 million jobs. And
that contributes to your outlook on growth, right? Housing.
Correct.
That's why you're seeing 5% next year?
That's somewhere really around 4 to 5, right?
Right.
In that range. Yes, absolutely, because what we're seeing is household formation really recovering. This year is the fastest pace in several years, coupled with a tight apartment market.
Of course, Tom Lee put out that report this morning saying that the war on terror is over. At least it's a boost, right? A boost of confidence to the markets. What are you guys hearing?
Well, I want to start with oil because, remember, overnight, crude oil was down more than 2.5%. And in the first few minutes of trading of stocks, oil has actually moved back into positive territory. I was just talking to a trader, Mark Wagner of XL Futures, who said, look, you quickly get back to the big story, which is demand, summer driving season, and all those other factors that obviously got missed because of the huge developments overnight.
That's the same thing traders are telling me as well all morning here, that this is one of these mini events here. Not that this is not a big event here, but in the overall scheme of things, the overall picture, the macro concerns, they're still there, especially for things like oil. It's one of the reasons why you saw people perhaps capitalizing and buying that dip, so to speak.
Yeah. Well, again, with regard to oil, our oil strategist really does think supply and demand are driving oil. So, there's tightness, which they see developing through July, there's upward pressure on prices.
There's not a huge fear premium built in that you would see sold off.
Correct. Even what's happening in the Middle East, in Libya, really is about supply and demand. There's true shortage until Saudi capacity comes on. But with regard to stocks, I think this is exactly what we expected. We think people are trying to fade this rally, and they're overlooking the fact this is going to have long-lasting positive effects on the stock market.
So it'll be an inflection point in 6 months.
Correct.
Time. Okay.
That's right. I think we're going to look back and realize this is a secular bull. We're at 14.25, and we're wondering why people are still carrying so much cash.
Tom, great for you to stick around. Thank you.
Thank you.
Good to see you again.